This is Jeff Miller from A Dash of Insight, continuing our interview with Bob Dealey, creator of Mr. Model, and looking at the history of recessions over the last several decades and the role of Mr. Model in forecasting these and the role of policy in interpreting the messages from the model. To facilitate this, we've switched from the chart we've been using in the other examples. We've blown up the last few recessions, and we're going to focus on this period leading into the most recent recession, where it looks like we had what we might think of as a false positive here. The series is advanced by 9 months, so you have to think of this signal as coming 9 months earlier than it is on the chart. We're going to talk about this period and also the recovery from the recession and kind of where we are now. Welcome back, Bob, and why don't you take it from right in this segment here?
Thanks, Jeff. The model began to tell us that something was going wrong basically in late 2005 and early 2006. And the signals that we began to get there have to be put in the context again of policy. The Fed had been raising the Fed funds rate, as you may recall, by 25 basis points at every meeting for 2 years. And the long bond did exactly nothing, much to the surprise of Greenspan and Bernanke. But the yield curve flattened.
The conundrum, Greenspan
Indeed.
called it.
And we began to tell people that flat yield curves are sources of concern. In addition, we began to have the movements in inflation, some of which were associated with gasoline prices, and that started all the way back with Katrina in 2006. The result was the pattern that you see in the aggregate spread, where it was fluctuating around 200 basis points, and something that we began to advise clients that conditions were becoming unstable. This meant different things to different people. If you were an equity investor, it meant one thing. As a fixed income investment, it might mean something else. If you were selling trucks, as some of my clients do, it meant something even more ominous. The downturn in the economy then began to really shape up, and we had the actual business cycle peak in late 2007. The model continued to send signals of instability through 2007 and into 2008. It began to suggest that the economy might recover, and indeed it eventually did in 2009. But once the signal took off to where we began to get readings in excess of 400 basis points is when we began to tell our clients that we thought the recession would end. Is this as good a performance as it had in other recessions? Probably not. The other signals were clearer. But this signal was unmistakable, that conditions of instability were there. They were there for a long time. And it's part of the reason why I have rejected arguments that somehow there was a surprise to this recession. This did not sneak up on us. We had ample warning.
So, this period of the recovery, well, let me take this for a moment first. So, you were not actually telling your clients in 2006 that we were about to have a recession. You were saying we were on warning. Is this where you start to look at coincident indicators and other factors to sort of confirm?
We do. And the relationship between the leading and coincident indicators is something that we can use this chart to set up if we want to talk about it in more detail. But this is one of those things where there are two messages. First, the warning that was confirmed, and then second, the signals about the recovery, which were also subsequently confirmed.
So the recovery signal looks like it came a little early also, but there was still a lot of skepticism well into 2009 about whether we
Absolutely.
were getting out of this recession at all. This must have been an unpopular forecast for you.
It was a difficult one to make, and one that we can elaborate on if we have a few minutes later on.
Thank you, Bob.